Hey, it's Cashflow Mike, and today I want to talk about forecasting your cash flow for your small business clients. Now, it's one of the biggest questions I get is how to do it, and I've got an extensive forecasting program called Forecasting by the Numbers, but today I'm going to give you a simple method, a shortcut just to get you going. Let's be real, right? Most businesses don't go under because of a bad idea. They go under because they ran out of cash and didn't see it coming. The worst part, they don't even realize how close they are until the checks start bouncing. So if you're an accountant, a bookkeeper, a fractional CFO, one of the most valuable things you can give your clients is to look ahead at a roadmap for their cash flow, right? This is what we're diving into today. You don't need a fancy app. You don't need a financial wizard. You just need a system, right? That's all it takes is just a system, right? I've built fancy apps. I've built fancy spreadsheets. I'm building another app to do it right now. I've got friends that build apps. You just need a system, and sometimes the more complicated you get, the worse it can be for you and your clients. So today we're going to answer the question, how do you forecast cash flow in a way that business owners can actually understand it and use it? So let's get into it. Cash flow forecasting isn't some mythical accounting art. It's not guessing, and it's not budgeting either, right? Budgeting is the intention for the money. Forecasting is about mapping out what's going to come in and what's going to go out and when it's going to happen. It's about three different things. It's about frequency. It's about cash in, cash out, inflows and outflows, and predictability. Is it going to happen? Do I think it's going to happen? How confident am I? What you need to know is when you'll need to get more gas, right? We're talking about that cash in versus cash out because you know there's going to be a bump in the road at any point in time. I want you to think about forecasting like driving with a GPS. You can plan stops, you can reroute if traffic hits, and you can avoid surprises. Same thing with your cash, right? Just like a GPS for your car, you be the GPS for your business. It's the same thing with your cash. So when you help a business owner, you can see what's coming and they will survive, right? So think about that. When you help this business owner see what's coming, they're going to be able to survive and know that they can survive because they're able to take action. You help them plan and grow and sleep better at night. So to get started, let's just break this down into three simple levels. Just three levels. They're simple, they're practical, and they're real. The first level I'm going to talk about is short-term forecasting. What's short-term? This is your day-to-day operational view, right? It's usually about 4 to 6 weeks out. Farther than that, you get less confident. Little things can throw off your forecast. So 4 to 6 weeks out, day-to-day short-term forecasting. Imagine telling a client, hey, in 3 weeks, you're going to hit a low cash point, right? You're going to be low on cash, but here's what we can do about it. Game changer. Nobody's telling you that. Nobody's being that warning sign. You definitely can be. You can help them out, help them avoid things. Imagine it's just like crossing the street. It's just like looking both ways. When you cross the street, you want to be able to see what's coming. This is seeing what's coming, and it's seeing it before it's on your block. So during this short-term forecasting, you're going to be looking at things like upcoming invoices, that we expect to get paid, regular bills like rent and payroll that are going to be due, your credit card payments and other tax obligations that are coming up. This forecast keeps the business running smoothly and it prevents short-term surprises. So it brings me to the second level. You can probably guess it. It's midterm forecasting. This is going to be your strategic window, and it's about 3 to 6 months ahead, right? So we got 4 to 6 weeks. And then 3 to 6 months. In this one, you're going to be looking at things a little bit more broadly, a little bit. You're taking a step back. You're looking at seasonal slowdowns, right? Am I going to sell more because it's Super Bowl? Am I going to sell more because it's the middle of summer? What are your seasonal slowdowns? Looking for those things that change just because it's a different time of year. You're also going to look at those bigger expenses like equipment purchases. Maybe you have to do those one-time purchases to keep the equipment running, or you want to upgrade, or whatever that is. This is when you take a look at those bigger purchases during that 3 to 6 month period. You also want to look at hiring decisions. You want to be able to look at that 3 to 6 months out because you want to plan for new people to come in the door. It shouldn't be a spur of the moment split decision. Am I going to add headcount or not? Also, take a look at the contracts you got out there. Are there any changes coming up? Is anything due? Is it going up for RFP? Is there an escalator clause where you can raise the rates? Those are the types you want to take a look at during this 3 to 6 month period of what's going on so you don't miss it. This is going to give your business room to adapt. And then the last one is long term. And long term is more big picture, really strategic thinking, right? This is where we're going to talk about a year out, right? What's happening a year? I see people all the time go, oh, we need a 3-year forecast or a 5-year forecast. Yeah, maybe for your dream, but not for anything that you're going to live on, because everything changes. The world's going to change in 3 years or 5 years. 1 year out gives you a strategic viewpoint of where you want to be at this point in time next year. This is where we're going to be thinking about things. Can we afford another location, or should we take out a loan? Remember, you need that 12-month trailing period of trends to be able to show the bank that's the way you run business. And what kind of buffer do we need in our cash reserves? Remember, I always preach that you need 3 to 6 months operating expense. Don't pull more out of your company than that. Try to keep that as your cash reserves. 3 months gives you time to react to anything that's going to happen. So you don't have to start at level 3. I'm going to tell you that. Start at level 1, add in level 2. If you can get to 3, you're really cooking with gas now, right? Let's just start with the short term and build from there. So here's my simple method that I call the cash flow forecasting blueprint. Step 1, I want you to start with your cash on hand. Don't use any fancy accounting number. What do you got in a bank account? Just pull the bank balances as of today. That's your starting point. Then I want you to look at what's coming in. I'm talking about real cash, not sales that are booked, but payments that actually are expected to hit the bank. Pull your accounts receivable list, what's due and when, and try to mark that out. Then think about the predictable income. What if a client pays you $2,000 on the first of every month? Put that in. That's predictable. It's not necessarily an accounts receivable, but we just talked about subscription and recurring based. What's going to happen? Put that in. Remember, it's about confidence, frequency, and amount. So after you map all the cash in, let's map the out. Start with your fixed expenses, things that you have to pay if you make 0 sales, rent, payroll, insurance, anything that shows up every month just like clockwork, and it doesn't matter if you sell or not, you still owe it. Then layer in some of the variable stuff, some of the things that change. It isn't just the same amount month after month. These vary in amount, not a variable cost like cost of goods sold, but they vary in amount. You might pay more in utilities in the summer than you do in the winter or the fall or the spring. Think about what these things run during that period of time, such as your utilities, vendor bills. Maybe you bring in more inventory certain parts of the year to meet some demand. Credit card payments, those kind of fluctuate up and down. Your marketing spend, you might spend more in certain parts of the year. Equipment cost, all of those things to be factored in here. What are they and how do they change? Now, here's the biggest mistake that people make. They forget to factor in when that money actually moves. So when it moves matters, especially if we're looking at a 4 to 6 week time frame. Does it move in the beginning or the end of the 4 to 6 weeks? But it's not about when it's due, it's about when it clears the bank. We're not playing the float game out here. Timing is everything. 1 day early or late can make all the difference in how much cash is in your bank, and so you don't have return payments. Here's the last step. I want you to look for dips, right? Are there any weeks where the balance drops below your comfort zone? And your comfort zone should be 3 months operating expense. You don't want it to go below that. Sometimes I'm at 6 months, but 3 months operating expense. So if I'm spending $10,000 a month, I don't want my bank balance to be below 30. Think about that. Get in your head. Feel uncomfortable when it's below that amount. So let's just say you see that dip and you know that it's coming, and that's your cue to start this conversation. You can see the dip based on your forecast. And here's where it's going to get fun, right? This is where you step in your role as the guide, you as the advisor. This is where you're going to step in. You can see the dip coming. You know it's going to be there. You visualize it happening, and now you got a plan as well. So let's say that your forecast shows that in 3 weeks, your client's cash is going to go negative just because of the way the bills are rolling out. If it's going to go negative, you sit down and say, hey, okay, we got to figure this out. We got a big bill that's due and 3 invoices still unpaid. What if we reached out to those clients to collect a little faster? Or what if we delayed that equipment purchase by 2 weeks? This is where you can move, right? Now, these things aren't all set in stone. You control the timing, but it takes you looking at it and knowing it's going to happen to be able to know what to control and what you can move and what you can't. But boom, you're not just a bookkeeper or an accountant anymore. You're helping them make decisions, real-time decisions that affect whether they make payroll or they take home a paycheck themselves, right? This turns you into the financial co-pilot. And that's where you're going to build your loyalty, right? Your loyalty, your trust, your long-term clients. This is where it all gets built because you're looking out for their best interest and you're doing it before a problem occurs. So let me tell you about this contractor that I just worked with, right? He had a great business, good margins, but every month it felt like a fire drill. His crew was solid. The bids were coming in strong, but he was always nervous because he didn't know where the money stood. So we just sat down and we built a simple forecast, just like I talked about. We did 8 weeks, right? Just cash in and cash out. That's it. And in week 5, we spotted this $32,000 shortfall, right? He was going to be short. Wasn't going to be able to make his bill. So what we do? We collected faster from some slow paying clients. Why can't I say that? We collected faster from some slow paying clients. And then we pushed back a material order by just 1 week. We rescheduled one of his personal draws, something we were going to transfer into his transferable value account. We rescheduled that and pushed that out a little bit. But there was no crisis, there was no overdraft, and this was the first time in 2 years that he slept through the night. He didn't worry about it. Normally he was waiting for it to happen, for this big avalanche just to roll him over. Now he knew he had it covered. Forecasting is also not about being perfect, it's about being prepared. So when you help your clients see what's coming, they're going to stop guessing, right? They're going to stop panicking, and they're going to start making decisions like real business owners. That's where you come in. That's your help. That's your magic touch, right? And you don't need to overthink it. Just start simple. Stick with it. Use the conversation tools that we talk about, and your clients are going to thank you for it. Hey, I'm Cashflow Mike, and forecasting is how you go from reporting the past to creating the future. So let's go help your clients actually take control of their cash. Go check me out at cashflowmike.com.